Okay, home prices are rising at 3 times the Fed's inflation target. Case-Shiller was released yesterday. We're going to review that today. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is December 30th. This will be the last video for the year 2020. I am sure we're all sad to see 2020 go. I think we all need it to go away. Hopefully next year it'll be a little nicer, a little easier, and we can figure out this housing mess. Randy Patrick here, putting the realism back in real estate, and let's get it on today. So again, big opportunity with respect to what's happening in the new year. For those of you who are not already subscribers, if you could help my channel grow and do me a solid over the holiday season, smash the subscribe button. I'd really appreciate that. So thank you very much. So basically, this is the news of the week. Clearly, U.S. home prices, I guess, accelerate at the fastest pace since 2014. You'll see a lot of articles about that. As well, you're going to see some stuff with respect to seeing that the home prices are soaring at 3 times the Fed's inflation target across all U.S. cities. We will delve into that in a second here. So the whole point with Case-Shiller is that they produce their information every month, last Tuesday of the month, and guess what? Yesterday's the last Tuesday of the month. So it really looks at, I guess you could say, it's a tag along, drag along calculation. So we are in December. It's reviewing the home price indices for October 2020. So it's not as timely as, say, the realtor stuff coming from National Association of Realtors, but it's probably a little more comprehensive. So this is kind of like your go-to to see what's going on with respect to home price index. This chart really is showing the year-over-year, I guess you could say, percentage of price increases. So you can see, as you know, we were at the trough in 2012, the bottom left of the graph, and you can see how it's increased. So we had our big dip in 2019 because things did slow down with year-over-year appreciation. Then, of course, 2020 hit, the pandemic. You can see the dip there. Then we're kind of exponentially rising the past few months. So that's the situation with respect to what's going on with the composite index. And here we can see that the Fed inflation target is the red line at 2%. And if you take a look at the one-year price change by metro areas for both October 2020 and September 2020, so year over year compared to this time this month, that month the previous year, you can see that it's blown well past the 2% inflationary target set by the Fed. And you can see that the green is September, and then the blue teal is October. So green was reasonable, and for year-over-year increases in the 20 major cities, and basically October blew that away. So again, there seems to be no end in sight for this crazy home price appreciation. This is the formal release from S&P CoreLogic. So ultimately, this is called the S&P Dow Jones or S&P CoreLogic Case-Shiller U.S. Home Price Index. There are 3 of them. There is a national 10-city composite and 20-city composite. Ultimately, in the end, we're looking at some big numbers here. Some locations in the double digits for year over year. Note that Wayne County, which is the Detroit, Michigan area, for whatever reason, they're having difficulty since COVID started reporting on their statistics, so they're unable to generate some of that information as well too. So just as an FYI. So as we go through CoreLogic, year over year, we're talking about 8.4 annual gain for the overall index for Case-Shiller from October of this year to last year. That's up from 7% the previous month. The 10-city composite came in at 7.5% increase, and the 20-city came in at 7.9% year-over-year gain, which is up from 6% from the previous month. So the winners, everyone's a winner in this list, but I guess the winners with respect to the top 20 are Phoenix, Seattle, and San Diego. So they continue to report the highest year-over-year gains among the 19 cities, excluding Detroit in October. Phoenix led the way with a 12.7 year-over-year price increase, followed by Seattle with a 11.7 increase and San Diego with a 11.6 increase. So pretty substantial. All 19 cities reported higher price increases in the year ending October 20 versus the year ending September 20. So everything sort of jumped up there. So what's causing this? Well, we all know the lack of inventory. We all know low interest rates, and the fact of the matter that I guess you could say the summer selling season was paused by a couple months. So maybe we're seeing the result of that happening now. So therefore, when you see, sales and values increasing, it could be, because of the timing of the year as well too. So the national index only had a 1.4% month-over-month increase, which is not too bad. Ultimately, in the end, as they say, national composite index gained 8.4% relative to last year. And we've noted before that a trend of accelerating increases in the national composite index began in August 2019, but was interrupted in May and June as COVID-related restrictions produced modestly decelerating price gains. Since June, our monthly readings have shown accelerating growth in home prices, and October results emphatically emphasize that trend. The last time that the national composite matched this month's 8.4% growth rate was more than 6.5 years ago in March of 2014. Although the full history of the pandemic's impact on housing prices is yet to be written, the data from the last several months are consistent with the view that COVID has encouraged potential buyers to move from urban apartments to suburban homes. We'll continue to monitor what the data can tell us about this question. So again, they're suggesting that people are leaving, the urban cores with respect to smaller apartment condo style residences, going to the suburbs and buying single family homes. So that's what they're suggesting here. Clearly, Phoenix led the increase for the 17th consecutive month. So for almost a year and a half, Phoenix has led the 20-city composite index with year-over-year price increases. Big time. Seattle and San Diego in second and third place respectively. Prices were strongest in the west and southwest regions, but even the comparatively weak Midwest and Northeast performed incredibly well. So there you go. So it seems like every market had an uptick compared to last year. So this is this supporting graph here shows the annual return. So it's the year-over-year return based on where we're at in the chart here. So ultimately, you can see that the dark thick line is the national composite index. The 20 city line is the dashed line. The thin black line is the 10 city. But you can take a look at where things are going, and you can see that we had peaking in 2004, 5, and 6, dropping into 2008 to 10, kind of spiked up again a little bit in 2014, dropped back down. We see the pandemic dip, and now we see it exponentially going up with respect to that's percentages. That's the year-over-year change in percentages based on a monthly basis. So that's not the index. That's just the way the percent change looks. Now, this is the index. So essentially created by Robert Shiller and his partner, whose last name is Case. I don't remember what his first name is. Regardless of that, this has been kind of used as the standard to see where price points are and where home values are heading. It's a complex, calculation based on sales pairs, and it goes back and does some averaging as well too. So that's why it's not readily available. It usually takes a couple months, but we can see that we peaked in 2006, and then we troughed in 2012, and it's been a pretty steady incline over the past 8 years. So where we are is the top right. That's where all the indices, the national, the 20, and the 10 are basically peaking right now, and it's way above where they were with the last housing boom. Simple as that, in 2006. Now, this chart shows the housing boom bust peaks and troughs for the three composites, along with the current levels and percentage changes from the peaks and troughs. So where I go is I go to the national index, which is the top line there in the chart, and go to the far right, and it says the percent from peak. So the national index has risen 24.5% from the previous peak, which was in July 2006. You can take a look at what the peaks of the 20 and the 10 city composites as well too. The whole point, though, is the national side, we have grown almost 25% since 2006, which is pretty substantial. So again, you can call it what you will. This, if we called it a bubble back in 2006, I think it's still a bubble today. Reason why I say that is that there's indications, and you don't see it here, but wages have not kept up with the pace. Wage growth has not kept up with the pace of housing price growth over the past since that last housing crisis. Simple as that. And you can see from the trough, we had our peak and again nationally peak in July 2006, trough in February 2012, and it dropped 27.4% from peak to trough the first time around, and now we've grown from trough to current peak 71.6%. So there's been a pretty significant swing with respect to where it's been, gone, and where it is today. So there you go. All right, this is the 20 city, and I'll read them out for you guys. I'll put the link to the this actual, we'll call press release, in the information section of the video. But everything increased. There was nothing that came in, I think, below 6%. So Atlanta was up 6.8%, Boston 9.4%, Charlotte 8.6%, Chicago 6.3%, Cleveland up 9.5%, Dallas 6.5%, Denver 7%, Vegas 6.4%, Los Angeles 8.4%, Miami 6.8%, Minneapolis 7.8%. New York was the lowest year-over-year increase at only 6%. Phoenix led the way with 12.7%, Portland 8.9%, San Diego in second, 11.6%, San Francisco 7.7%, Seattle 11.7%, and we've got Tampa at 8.6% and Washington at 8.2%. That's the situation that we're in right now. So basically, every one of the 20 cities had pretty substantial year-over-year price increases for October 2020. Simple as that. All right, let me hit the next chart here. So this is, I'll bring this chart up in a second here, a little higher, like a little larger. But basically, when I mentioned that, the housing price is changing or increasing at 3 times the speed of the inflation target, well, that's the problem. So house pricing really is out of control. So it's increasing, faster than people have predicted. So the Consumer Price Index, CPI, does not show in house price inflation because the Consumer Price Index with housing uses a non-market rent index to capture the trends in housing inflation. So the Bureau of Labor Statistics estimates that the non-market rent index has increased 2.5% in the past 12 months, or 450 basis points below the rise in house prices. So their comment is, if actual home prices were used in place of rents for the core CPI, CPI would have registered a 3% gain in the past year, nearly twice the reported gain of 1.6%. So really, it's outpacing what they're reporting. Again, rising consumer price inflation is added to the list of unique features in the 2020 recession. Others include an increase in corporate debt levels instead of debt liquidation, rising equity prices instead of share price declines. Ultimately, what they're saying is that the next economic cycle will be filled with unique tipping points, and no one should assume that policymakers can control or offset them. So really, what they're saying here is the government doesn't have control of where this market is going. They keep printing money. They're encouraging, home value increases with respect to, keeping interest rates as low as they can, and couple that with low inventory, and I think just the shifting in how people work, how people want to live, and where they want to live is causing some significant increase to home price values, which is making difficult for people who are trying to not buy properties as expensive as they are out there. As simple as that. Now, if I go to blow this slide up, you can really see this is a funny correlation. So ultimately, in the end, the red line is the CP owner's rent, so the consumer price index with respect to how it's housing, how it's actually calculated, and what they're using, and the blue line is Case-Shiller house prices. So you can see that where we are towards the from looking back, it looks like the 1990 to where we are today in 2020. You can see that, and the gray parts, I guess you could say, are recession areas. That were the gray vertical line shadows is where they would call depression or recession areas. So we can see that in 2007 and 8 area, that where the gray is, we saw rent decrease, we saw a home price decrease big time. The values, and then it's gone up a little bit. But you can see towards the right-hand part of the equation, or not the equation, the graph, that the rent is and the home values are diverging. So we see a significant kind of upshoot there on the blue line with home prices, and rental, the rent CPI is actually turning down the other way. And we know that specific locations like New York City, Manhattan, like the San Francisco area, other parts of California, where the uber expensive places where people are paying $3,000 plus to live in a 1-bedroom apartment or condo type thing. Those are they've been dropping about 25% or more in these locations, and there's a ton of inventory out there right now. I know San Francisco is increasing in their inventory, especially in their condo inventory, and same thing with Manhattan as well. So, it's interesting that where we are today, it just doesn't make sense. Like, there's divergence in those two sort of, I guess you could say, data points there, which really leads to the fact that I think this market is out of control. It has to stop at some point in time. I mean, everybody asks how high can it go, and I can tell you from personal contact and experience, I've got people who, I discuss this with, and I know who are in the real estate field, and they're moving out of California and out of New York, and they're coming to other locations like a Florida or like a Texas or a Georgia, because they're going, this is far too expensive, and we just see ourselves getting priced out of the market, or we don't see ourselves doing real estate successfully in those locations for rentals or whatever. So people are changing for various reasons, obviously, but to see the divergence here, I do think it's very interesting. And this is very interesting as well too. So this is a graph, and the green line is the CoreLogic 20 City Composite Index. You can see how the index has really increased, especially you go to the right hand part of the graph, how the index has gone almost exponential towards the right part of the graph there. The red line is it's called the buying conditions for houses. So it's University of Michigan buying conditions for houses, which is called home buyer sentiment. So apparently University of Michigan does a lot of analysis and surveys on consumer sentiment on a number of topics. They also do it for home buying, and you can see where home buying sentiment is. So house prices are exponentially high, and home prices have hit a sharp, it's not home prices, home buyer sentiment has hit a low point as well too. So obviously you can see how it was good in December of 2015 on the very left hand side, because things are looking good, and the home buyer sentiment has sort of up and down, up and down, up and down. But ultimately, it's been a slow decrease if you linear that out. You can see the big drop with respect to when the pandemic hit, came up a little bit, and now here we are in the fall in September. Once September hits, looks like it's just kind of tanked. Like October, November, and December, it's dropped dramatically. So it's just interesting to note that home buying sentiment is completely opposite as to where price points are going. So that's just interesting, which to me, you call it buyer fatigue. People are just tired. They're tapped out. They don't want to buy anymore. They don't want to haggle. They don't want to compete and have to place bids without inspection contingencies and stuff like that. So I think it's really starting to take a toll on people. And I guess it's at some point in time, we're all going to cry uncle and just say, we're just not going to buy these homes at this price. But who knows? Because we do have a low supply of inventory. People do have to buy and sell homes. People do have to buy to live for various reasons. I get that. But I just think that we're seeing greater divergence now. We're seeing divergence in price point with home buyer sentiment. We're seeing divergence in home price appreciation with respect to consumer price index calculation. So we're starting to see things, we'll call it spread out more or diverge more, which might be an indication that maybe we're getting tired of this market and we need things to change down the road, or maybe not so far down the road. So that's a scoop on that. So ultimately in the end here, where is this market going to head? You know what? It seems to, every month it surprises me. I mean, well, not really, but when I look at the numbers, I'm like, okay, you know it's going up, and you hear the little bits from Realtor.com and NAR, et cetera, about where things are going. I mean, I saw this just before I recorded that, pending sales are down for the third straight month. Now, are they down for the third straight month because there's not enough homes to go pending status, or because people are just, again, tapped out and not wanting to buy as many? So those are interesting statistics. We just don't know what the root cause of all these things are. But in the end, we all know that we're tired of seeing these home price appreciations go higher and higher and higher. We need some relief, and hopefully as things open up, we'll start seeing some more distressed property come in the market, and people will be able to access some stuff that is a little bit cheaper, or at least have methods or ways to get at cheaper property. So as I always mention, housing narratives in play here. There's two of them. We call it the K-shaped housing market. The problem is we're not seeing the bottom part of the K. We're seeing the top part of the K keep rising. Housing market stalled. There's very little inventory left. We need to see some some relief and some movement on some of these moratoriums and a lot of these pre-foreclosures and foreclosure sales to get some stuff happening in the marketplace. So that's what we're looking forward to. There are properties available right now. You just have to know where to look. So distressed sales are where you need to look. And what are distressed sales? They're basically bank owned, which is real estate owned, or short sales. Now, there's not many of these in the market. That's why there's only 1% of them that actually occur on a on a monthly sales basis, according to the National Association of Realtors. So, basically, you got to look at the distressed sales opportunities, or get them before they get to the MLS, etc. Now, what's the starting point for distressed sales? Well, we're into it right now. We're right there. We're right on the cusp of this. Mortgage delinquencies. We've got a ton of mortgage delinquencies. I spoke about that the last video. FHA delinquencies doing record highs as well too. We have mortgage delinquencies. We have people in forbearance. We've got 2.7, 2.6, 2.5, depends on the week. We have 2.5 million people plus in forbearance. A lot of those people in forbearance are going to become foreclosure filings, notice of defaults, etc. And eventually those are going to go to foreclosure auction. So that's where the distressed sales, that's where the distressed people go. They end up in these buckets. And when they end up in those buckets, they're opportunities for us. What's the end point for distressed sales? Very simple. It's going to go to auction if nobody helps them or they don't take control of their own matters. Third-party bidders will buy them at the auction. Bank or lenders will take them back as real estate owned if nobody else buys them. The homeowner has to leave. They get evicted. Tenants will get evicted if they're in there as well too. Homeowners will receive ongoing financial issues. That's what's going to happen as the endpoint in distressed sales. Or homeowners can give their property back voluntarily. It's called a deed in lieu of foreclosure, which really is a foreclosure in your credit. So not much benefit there. Or they can do a short sale settlement, which tends to clean things up on average for most homeowners. And there's a lot of benefits that go along with that. That's what I always recommend if you can do that. So the point is, I just analyzed last 3 months of foreclosure auctions locally here in my market. I'm seeing some very interesting trends that are going out there, which I'll be incorporating into our business and our clients as we go forward. So if you want to talk about that, you give me a shout. I'll tell you about it. Just connect with me. That's my email address. Send me your contact information. We'll talk. I'm around tomorrow part of the day. I'll be around New Year's Day and the weekend as well too. So now's the time to talk about this. Now's the time to figure stuff out. Get involved with this before the masses jump on. I tell you, it will be coming as the new year rolls around. So having said that, I want to wish everybody number one, a happy new year. Let's say goodbye to a terrible 2020. We'll wish everyone health, wealth, and happiness in 2021. And hopefully we will all achieve our real estate dreams and goals. So again, everybody, take care, and we'll look forward to speaking with you in the new year.